Hey everyone, it's Adrian CryptoBirb speaking. Welcome to the new episode of the Nest Show podcast. Well, not only do I get really have this great pleasure to be hosting one of the excellent analysts, one of the excellent professionals in the field of CFA certification, but I also have on the show today a guest whom I truly admire on the personal perspective. I really admire his works. He shares lots of very valuable content from the very important institutional viewpoint. So we're going to talk about this overall principal rules for 2023, a little bit of forecasting maybe with our today's great guest, Mike Singleton, CFA, who is a senior analyst in Invictus Research. How is it going, Mike? How are you doing?
It's going great. Thank you for having me, Adrian. I'm honored to be here.
That's excellent. I've been looking up to your works for quite a long time, to be honest, and I have literally no idea how you still have not got like 100,000 followers or something on Twitter. It's like a must have, So hopefully with this show, you're going to get a little bit of more traction and a little bit of more recognition that you certainly deserve, because there's so much of interesting points, so many of interesting points that myself I'd love to talk to you about and hear your opinion about. But before we roll in fully into the depths of the markets, please help us introduce a little bit of your background story. Who's Mike Singleton, CFA?
So I think the story probably starts in college. I went to the University of Notre Dame. Notre Dame, the business school tends to be very value oriented, very bottom up oriented. So the investing style that they support most readily is kind of the Warren Buffett, Ben Graham style of looking at individual companies, determining what their competitive advantages are, looking at the valuation. And if you find a good company at a fair price, that's sort of the best way to invest. And so my first job out of college, I worked at an investment firm called Broad Run Investment Management that invested with a very similar style. And candidly, it was a wonderful experience. I learned a ton when I was there. I got a lot of responsibility from a young age. I got to lead my own investments from a very young age, which is kind of unusual. And I got to go to conferences, present new ideas to people, meet a lot of really interesting people. And one of the things that I sort of noticed as I was doing the investment circuit, I guess, was there are a lot of really smart people on Wall Street, really smart. And a lot of times when these really smart analysts covering industrial stocks or technology stocks or whatever would get something wrong, they weren't getting it wrong because they were dumb. They weren't getting it wrong because they didn't know enough about the company. A lot of times they would get things wrong because they would miss the forest for the trees. They would miss the business cycle. And over the course of my time at Broadrun, I actually sort of developed a mentor outside of the firm that was more top-down, more macro-oriented in terms of his investment process. And I noticed that he was getting a lot of calls right that I wasn't getting right or my colleagues weren't getting right. He was making predictions about things and asset classes that I didn't really have the first idea of how to understand. And so I figured at a certain point, after he got enough things right, I've really got to learn how to do what he's doing. I've got to learn how to analyze the business cycle. I figured I could improve my bottom-up batting average if I also learned how to analyze markets top-down, sort of like what you do with the CMT charter. And so I spent a lot of time working on that. It turns out it really did help. I had continued to have a good run at Broadrun. After a while, I figured I could sort of create more value if I started up on my own. And so that's how I started Invictus. And I could go into that in a lot more detail, but maybe I'll stop there.
I would argue that's just a brief of what you're really doing, right? Because what you're really doing as a CFA, I've seen tons of very valuable charts that you share each and every single day on Twitter. Tons of very good and well thought, well presented, ideas, concepts about the market, right? With sprinkled with a little bit of forecasts. However, if you were to tell and introduce the overall concept and behind the Invictus Research to the audience, to the viewers, listeners, what would that be?
So there's probably a few things. There's probably a few things that I would point out. One, from a content perspective, it tends to be very business cycle oriented. So what does that mean? It's kind of a vague sounding phrase. At Invictus, we define the business cycle to be the real growth cycle, the inflation cycle, and the monetary policy cycle, or the interest rate cycle, which is determined more or less by the Fed. And those three subcycles together form what we call the business cycle. And the reason that I at Invictus study the business cycle is because if you run all of the regressions and the back tests and whatnot, the business cycle, defined sort of broadly, accounts for between 60 and 80% of the price action for individual stocks. And if you're looking at sectors or style factors, it can be even more than that. And so I found when I was just a bottom-up analyst, I found myself frequently confused or aggravated by the price action. And it was easy to sort of blame Mr. Market, as a lot of value investors and bottom-up analysts are wont to do. But when I learned about the business cycle, it really opened my eyes as to why stocks move outside of their individual company fundamentals. So business cycle is what we focus on in terms of content at Invictus. And then I would also make a point about presentation, because most Wall Street research is delivered over email and kind of boring PDFs. And there's a lot of content out there that sort of is delivered that way. And I know when I was working in the business, I really did not like that. I found that extremely boring, extremely non-differentiated. And so at Invictus, our work is typically delivered over video. So our flagship products are delivered over video. It's very heavy on charts and graphs because most people consume information better and learn more efficiently when there's a visual aid component. And so at Invictus, we aim to deliver hedge fund quality business cycle research, and we do it over video in a way that's accessible, not just to professional hedge fund managers, but also to retail investors and anyone who wants to learn more about the markets.
That's very well thought through and very well put through, actually, the way you said it. I'm just looking, of course, at your amazing Twitter posts, and one that caught my attention. Of course, we can get a little bit deeper later into the discussion about that. However, I wanted to congratulate to you because it seems that you visited Charles Payne, yeah, isn't it right? About making money. How was it?
I did a couple of days ago. Charles is great. I've been on the show a few times. He's an excellent host, and I always enjoy making an appearance when he invites me.
Man, I mean, I'm just looking at this good-looking gentleman in the suit, Charles Payne, asking all those questions, and it seems that it did regard, this latest Jay Powell testimony. Isn't that right?
Yes, it was. The recording was right after the testimony.
Cool. So, what did you spill the beans about there? What was the topic?
I guess the first question was about Jay Powell's testimony before the Senate Banking Committee. I will tell you that historically, those congressional testimonies tend not to be super information rich for us as investors. And the reason is because most committee members use it as an opportunity to get sound bites for their constituents and to sort of make a show, and not to really learn anything that would be important from our perspective as investors from the Fed chair, or from their perspective as policymakers. So it's a lot of grandstanding. That said, I did watch it so that everyone else wouldn't have to. And I would describe the content of the testimony as hawkish on the margins. And the reason for that is that the inflation data continues to run hot, and the Fed is kind of between a rock and a hard place, right? Services inflation, which is sort of the sticky inflation that's really hard to get rid of, is continuing to run at between 6 and 7% on a 3-month annualized basis. So that's sort of the highest frequency measure that we look at. And durables inflation is showing signs of resurging. Right, we saw the 4.3% month-over-month print in used car prices for Manheim the other day. That's the opposite of what the Fed wants. The Fed does not want to see durable goods disinflation reversing course and contributing to headline inflation again, with services inflation continuing to run so hot. So against that backdrop, we think it's very, very likely the Fed continues to hike higher, faster, and for longer than most investors are positioned for right now.
That actually translates, of course, to so many other discussions, and threads that we would have throughout this podcast, Mike, about the forecasting about the virtue of a potential recession, right, be standing somewhere right around the corner. However, before we go there, let's actually just kick it back and try to tackle this eternal battle, that the CMTs and the CFAs, would often kind of just make fun of, right? Because I'm talking about so-called momentum investing, that is the very, very basics and the foundation of something that we know as technical analysis, right? Which is a little bit often argued from the side of the value investors, from the value analysts, who would have this different style of investing, right? So what's your stance on actual comparison between the momentum and value investing? Is either of these better than the other?
So I would say when you're comparing two different types of investing, the answer is that they're almost always regime dependent. So there's going to be environments where momentum or growth stock investing tends to really outperform. Obviously, we saw a very long period of outperformance for growth stocks post the great financial crisis into COVID and the reopening. And now we're seeing a period of time where value stocks are really outperforming. I can tell you that the key to that dynamic tends to be what the Fed is doing. When the Fed is tightening monetary policy, value stocks tend to outperform. And when the Fed is easing monetary policy, growth stocks tend to outperform. And that might sound very simple, and it is very simple, but that tends to be the answer. The other thing that I would add is you could make the distinction between technical analysis and fundamental analysis. And unfortunately, it seems like there are a lot of fundamental analysts and technical analysts who adhere to their discipline as though it were a religion. And the truth is, both of them have immense value, and they're both better together. I think that there are a lot of bottom-up fundamental investors who could add a ton of value to their own process by understanding the technicals, by understanding how the market cycles and how the market reacts to different information, and even pattern recognition to some extent. And likewise, I think that there are a lot of technicians who would benefit from understanding the fundamental drivers of the business cycle, because ultimately big economic trends are what drive big market trends, and from understanding the sequencing of the business cycle. So long answer short, I think they could both learn from each other.
That's very that's actually what I take away, what I did take away from my CMT charter preparations, right? Because there was I remember that perfectly. There was this entire chapter dedicated to momentum investing in terms of debunking those myths, right? That the profits are sporadic, and that they are not persistent, or that this is mainly having no sort of like predictive role to it, and so on and so forth. So of course, I perfectly agree with you, Mike. That it's very regime dependent, and you're always going to kind of like people would always be able to find and cherry pick the ones that work and the ones that do not work, right? However, the main message delivered by this CMT association stance was as well that it does work best when combined, right? When you combine this value investing, when you combine it with momentum investing, right? Be it whatever it is, of course, the 60-40 portfolios, there are many different models to it. However, they both tend to work together rather than exclude, right? This is pretty interesting. I'm really glad you put it this way. And this actually directly takes me to the next point, right? Because last year, there is little to question. This was a very difficult year, right? 2022 was a very difficult year across so many levels, so many layers. Of course, we are talking about the bear market. The bear market often associated with the midterm elections, where historically and seasonally speaking, those midterm years over the decades tend to be the ones putting in the troughs, putting in the bottoms in the market, right? So they are either extension of the bear markets or the bear markets alone. So I would love to ask you, Mike, and get your thought about that. What do you think the post bear market economy situation is for now?
So maybe I would start by caveating that technicians tend to be much better with seasonality trends than I am. At Invictus, I would say I focus more on the business cycle and the sequencing of the business cycle and where we are right now in the business cycle and what tends to come next if you look at history. And so this is what maybe it would be helpful to take a step back and sort of go over the sequencing of the business cycle and what's happened so far and what we expect to happen next. So this is what I would say. In 2022, we saw the Fed really aggressively raising interest rates. So they raised the Fed funds rate, but pretty much the entire US interest rate complex trades with a very close correlation to the Fed funds rate. So the Fed funds rate is going up, everything else goes up. Importantly, the 30-year fixed mortgage rate goes up. So why does that matter? Well, that's a huge driver of demand for the housing market, right? So when the mortgage rate goes up, buying a new home becomes less affordable. And almost immediately, you will see mortgage applications start to go down. And we have seen that. I think mortgage applications, per the most recent data, are down 60% for new home purchases. I think that probably qualifies as a crash. If demand stays down long enough, you will see home builders start to react. And so they will stop starting new homes, right? They'll stop with new construction. They'll discount existing homes that they have on their inventory. Eventually, household spending on home-related stuff called durable goods, so think furniture, home appliances, cars. People will stop spending less money on durable goods, which likewise we've seen. Factories will see that demand for durable goods has come down, and in turn they will reduce production. So manufacturing production will go down, industrial production, or you can use the manufacturing PMIs as a proxy for that. And then eventually, after production goes down for enough, they'll start to lay people off. So the next step of the business cycle, the step that we haven't seen, is sort of that last step, the layoffs, right? We've seen rates rise, we've seen mortgage applications go down, we've seen new home starts come down, durable goods spending is down, the PMIs are down. But what we haven't seen is layoffs. And more specifically, what we're looking for is layoffs in the manufacturing sector. That's the sector that's most sensitive to policy because of its relationship with the goods economy and with housing. And so our expectation at Invictus is that we continue to see the Fed tighten monetary conditions, raise interest rates until we see employment start to crack, and more specifically, employment within the manufacturing sector. If you look back at historical recessions, where are most of the job losses? Which sector is the primary transmission mechanism for monetary policy? It's manufacturing. So when manufacturing unemployment goes up, those people who used to work in manufacturing, their incomes go down, they spend less money on services. And so the way that the Fed actually impacts the services economy is through the transmission mechanism of the goods economy. So hopefully that makes sense. That's where we are right now.
That does make a lot of sense, of course. And I'm really happy, and the audience is going to find it definitely very valuable for your bringing so many different and interesting macrofinance indicators, right? The way we put it this way, that help us actually track and navigate the business cycle. That's a very interesting stance, Mike. And well, of course, this, like you said, this lack of follow through in terms of the layoffs, is of course that the main battle that the Fed is actually fighting right now, and because they do have this job market mandate as well as price stability mandate, right? So they're somewhere in between, kind of like try to approach and help with something that they refer to as the soft landing, and at the same time they're really looking at the charts of the deepest yield inversion since the 1980s, right? So if you were to comment on your own financial forecast or the ideas regarding the recession for this year, what would that be, Mike?
So this is what I would say. I would say that I think the big question mark, I think the most important question, if you could know the answer to any one question that you could use to make money in the markets, it would be, when will the labor market crack, right? When will a recession really begin in force? Because labor usually gives out and then you get a recession. So at Invictus, our forecast, if you want to call it that, our base case is that we begin to see some preliminary weakness in the labor market data. So think initial claims, the monthly employment situation, payrolls, the unemployment report, et cetera. Initial weakness by Q3 of 2023, and a more alarming sort of nonlinear spike in the claims data and the unemployment data by either late Q4 of 2023 or early Q1 of 2024. I think that as a business cycle analyst, sometimes when you understand the sequencing of the business cycle, you expect things to happen really, really fast, right? Like, hey, the Fed is already tightened, housing is already down. When are they going to start firing people? Isn't that the next thing to happen? And something that you have to have a lot of respect for is the leads and lags, right? So your models have to incorporate the leads and lags of monetary policy. And I think that there are a lot of bears out there that are going to be frustrated by the resilience of the job market, and they have been for several months now, because the tightening of 2022, the monetary tightening of 2022, the pain in the housing market shouldn't really flow through to the rest of the economy until the second half of 2023, and really closer to Q4, closer to 2024. And so that's kind of our base case at Invictus in terms of the timing.
That's very interesting, right? I mean, I think you've made a very, very, very interesting and valid point, in what regards to recession, right? And understanding the leads and lags, of course. There's always some sort of like a lag time before the recession or the actual interest rate start really working, right? Just like what Jay Powell often refers to, during his FOMC statements. And there is this dispute, almost I would say academic dispute, right, for whether we are not in a recession or whether the recession has already been there, right? If it's really defined by the coincident indicators, or more so by the preceding indicators, or the or just used for the confirmation for the ones that look back in the past. And there are so many different terms on how to frame this recession. So yourself being a CFA, obviously working with great success with Invictus Research, how would you define what the recession is from the financial standpoint?
So technically, recessions are declared after the fact by a government organization called the National Bureau of Economic Research, and they tend to look at 4 different indicators. They tend to look at consumption data, income data, employment data, and production data. And so, but when push comes to shove, what do you need to see? What tends to be the lagging most indicator, the necessary condition for a recession? It tends to be the employment data. And so I think by that standard, we're clearly not in a recession yet, because the headline measures of the labor market that everyone looks at are still very strong, which is simply to say that even regardless of the economic reality, I think those indicators are right. But even if they were wrong, that's what the NBER looks at. So we probably don't have a recession by their standard yet.
Yeah, that makes sense. That makes sense, of course, right? However, if we are to put it, of course, in terms of like just getting ready for it, right? Because the problem is that announcing that, post factum, is always going to be harmful to people who had been waiting for it, right? Because they're probably waiting for somebody to tell them, okay, a recession is here and a recession is now, so that they can, act upon it and get ready somehow. However, knowing that the recession is often kind of like claimed and proclaimed after the fact, many people would love to have the sort of like indicative, indices such as the interest rate spread, right? And I referred to it very briefly in terms of that the interest rate spread is the greatest. The yield curve inversion is the greatest since the 1980s, right? This is a significant push or pullback to the downside, I should say, -1 even between the 10 years and 2 years and the 10 years. So what is your stance, or how would you approach this matter from the interest rate spread? How far you believe it's accurate? How far you would say it has any sort of like essential value in terms of forecasting in Invictus Research?
So this is what I would say. I would say first, when you look at the statistic that tends to have kind of the closest correlation with the returns of the S&P 500, the ISM manufacturing PMI has a very close correlation. Now, that said, the manufacturing PMI tends to lag the S&P 500's performance by about 2 months, and so you can't use it as a leading indicator. But you can kind of use that as a baseline for understanding. If you can forecast the ISM manufacturing PMI, you can make a very reasonable guess at what the S&P 500 is going to do. So what I'll say is, most measures of yield curvature, including the 2s, 10s, tend to front run the ISM manufacturing PMI by about 10 months, which is to say the market by about 8 months. And there's a wide variation of outcomes to that effect, right? Sometimes it leads by more, sometimes it leads by less. But the yield curve is still a good leading indicator. It's certainly something that we pay attention to. Our work actually suggests that the 5s, 30s is the best measure of yield curvature for forecasting growth in the stock market and whatnot. But they mostly trade. They have a very high correlation with each other. When one curve inverts, you're likely to see other curves invert as well. So that said, I don't think that the yield curve is the best leading indicator. There are other indicators that we look at that have higher correlations with the growth cycle and even longer lead times. But the yield curve is one of the things that we look at and certainly spend a lot of time and attention on, and certainly something we would never ignore. But it is something that we try to put in the overall context of the business cycle.
Yeah, it does make sense, right? I'm asking this question on the purpose, right? Because anytime somebody just brings up, this inverted yield curve situation, that has been frankly going on almost for a year, if it's not even longer, since the inversion has started. Then this always triggers so many emotions. This always triggers, so many. I should say, like, overall emotional response from the people, from the audience. Whenever I just post a chart, on Twitter, reflecting this yield curve inversion, of course, people would always be like, yeah, of course, like you can never predict the future and so on. So, however, however, they are right? Still, what you mentioned, Mike, and I think it's very valuable and needs to be highlighted to the audience and to the listeners, is that there are certain signals that you should not simply ignore, right? It's not so much about kind of like just being 100% certain about the future, because that's off the table, that's off the records. We cannot ever be 100% certain about anything. However, if there are signals that are really permanent in terms of forecasting the recession, or that each and every single time the recession came in the latest history, it would be preceded by those types of indicators, such as this inverted yield curves, and then this should necessarily be ignored, isn't that right?
Right. And I would say one thing that gets lost, I think, in the discussion about the yield curve, because people like to talk about leads and lags, and this time maybe it's different. But I think what gets lost is the economic logic of why the yield curve is important and what it signals. So essentially, the short end of the yield curve trades 100% with Fed policy. If you look at the correlation between the 2-year Treasury yield, or the 1-month Treasury yield, or the 3-month Treasury yield, or whatever, and the Fed funds rate, it's very close to 100%. It ends up being between 96% and 98% usually. The long end of the yield curve trades, call it 80% on Fed funds. So it's still very closely correlated with Fed policy. But the other 20% tends to be the bond market's expectations for future growth. And so when you see the yield curve invert, usually what it means is that the Fed is raising the policy rate. It's raising the short end of the yield curve, but the long end isn't keeping up. And the reason the long end isn't keeping up is because it's forecasting slower growth. So the takeaway when you see a yield curve inversion is that the Fed has tightened policy to the extent that it's going to impact future growth negatively. And as it happens, the timing tends to be between 10 and 12 months in the future. So that logic continues to make sense today. The correlation continues to hold up reasonably well today. And so we're inclined to continue to give it credence as investors.
I love how logically you put it all together. I mean, it's just, I really admire your skills in putting very difficult terms in very simple language. That me being the listener, maybe I really told you, before we started rolling, the show, that there's so much I can learn from you, and I'm really thankful for this, because this is an excellent rundown, on how the things work in terms of the macrofinance and the business cycle, and which of course would regard and reflect, my next question, that refers to efficiency of portfolio, that regards the efficiency of the markets, right? Another academic debate always between the financial chartered financial analysts and the CMTs and the technical analysts, would be to what extent the market is efficient or inefficient, right? We know that from the technical viewpoint, those long fat tails in the return distribution often are represented by those strong persistent trends that are often those spirals, of the positive feedback and emotions and biases in the people, which are a source of inefficiency. However, if you were to put it, Mike, in the efficiency frames, how efficient are the markets in your eyes?
So that's a good question. I'd say pretty efficient, but not completely efficient. Excuse me. So I think what I would say is the efficient market hypothesis is a framework for understanding reality. It's a mental model. And a mental model is a good mental model to the extent that it describes reality well, and it's a poor mental model to the extent that it does not describe reality well. I would say efficient markets is okay. I think that there are better models. I think the fractal market hypothesis by Edgar Peters is probably a better one. I think what I would say is I think a more useful framework as an investor is to think about investing as allocating risk to different themes, right? So growth, inflation, and monetary policy are going to move in sort of a sinusoidal pattern forever. They're going to go trend and then peak, trend and then trough, trend and then peak, trend and then trough. And we know that the asset markets are going to react in somewhat predictable ways to those sine curves, right? So when growth is accelerating, you can be pretty sure that cyclical stocks are going to outperform defensive ones. If you look back at history, it's always been the case as far back as we have data. Likewise, if inflation is going to accelerate, you can be pretty sure that energy stocks are going to outperform. And so I think that there are a lot of investors that spend a ton of time thinking, well, what does the market know that I don't know? Or what do I know that the market doesn't know? And I think you would be better off trying to understand the business cycle and where we're going. One, what's happening right now, because a lot of investors don't even know that. And two, where are we going? And then what does history tell us should happen if your understanding of the future would prove to be correct? I think that's a much more helpful way of thinking about the markets than constantly wringing your hands about how efficient it is or it isn't, or what secret knowledge you might have.
I love how I put it, again, in a very simple terms, Mike. While learning about technical analysis and of course those market efficiencies, inefficiencies, what they brought, what CMT brought, to my understanding, is that the markets are often adaptive, right? So adaptive in terms of that at times they are efficient, of course, when there is a little bit more randomness and there is of course more sideways environment, more noise in the market. However, those spirals, like I said, those positive feedback loops often tend to deviate against any efficiency from the market per se. So this was kind of like a little bit of an run into my question about portfolio, right? Because you're obviously doing an incredible job with Invictus Research about providing very valuable business cycle details and insights. How does it translate to your or Invictus Research stance on what the portfolio should be, the model portfolio should be for this year and for the next year?
So obviously this will depend a little bit on your time horizon as an investor. I would say that Invictus doesn't have model portfolio, so to speak. That is a product that we're actually thinking about developing right now. But in terms of what might be some good allocation choices to make, I would say that one, being conservatively positioned makes sense here. So in 2022, what was going on? We saw slowing real growth, and we saw the Fed tightening monetary policy at the same time. That tends to be a very bad backdrop for financial assets like stocks and bonds. And that's kind of what we think is going to happen in the first half of 2023 as well. The difference between today and a year ago in 2022 is that we actually have a very attractive alternative to traditional financial assets in cash, right? Because now we have short-term government bills yielding 5% plus, right? And back then they were yielding almost nothing. And so we think a relatively large allocation to short-term treasury bills is a very logical allocation to make here. Nominally risk-free, super liquid allocation earning 5% plus as we head into a period of very high recession risk. That makes all the sense in the world. In terms of equity allocations, in terms of allocations more broadly, we would continue to favor value over growth. We would continue to favor short duration over long duration. So in the bond market, what that would mean is short duration government bills against long duration government bonds, right? As long as the Fed is raising rates, you're going to see long-term treasury bonds underperform, right? On the equity side, what that would mean is value stocks versus growth stocks, right? We would prefer to own short duration, cash flow generating businesses to long duration, growthier stocks. And, that's not exactly news at this point. We've seen value outperform for a while, but again, as long as the Fed is tightening, we should expect to see value continue to outperform growth. That makes all the sense in the world. We would say also that we prefer defensives to cyclicals. So if growth is going to slow, traditionally, historically, that means that defensives should outperform cyclicals. And so that's what we expect to see over the next year or so. Into the, through June, it's a little bit more questionable, but we think into Q3, defensives are a much, much better bet.
That's very interesting, right? I mean, there's so much, there's so many good points actually that you mentioned. What is very interesting is, that when I look at the historical data of the seasonal patterns, right? This is what we do as technical analysts pretty often. And we will look at this, and first of all, this so-called January barometer, right, with over the 72 years since 1950, would prove 83% accuracy ratio, stating that as January goes, so goes the year, right? We of course closed off, bullish in January, which kind of like translates to this bullish forecast for the year to close bullish on average. Plus, we are putting this in the context of the pre-election years, right, which historically, since 84 years. Had only had one losing year in the entire kind of like a spectrum, right? So 83 to 84 odds are that the year is going to be bullish and the most bullish within any kind of like a presidential cycle overall in terms of the average cycle. So this is very interesting, kind of like a stance to get your word from of course this macro specialist, saying that this capital preservation and this more withdrawn still capital mode is to last for 2023, right? On the other clashing side, on the other side that just brings a little bit of a dissonance from the technical standpoint, you would look at this historically bullish data, right? So do you have any kind of like any method model that you would use in Invictus Research or for your own personal studies that you would acknowledge any bit of the technical studies there?
So a couple of points. So first, I would acknowledge that there are some cyclical charts that technically look pretty strong, or even attractive, just in purely technical terms. I would say that I would be hesitant to buy the breakout, so to speak, because I think that the Fed is going to effectively put a cap on where the market can go. Right? If financial conditions ease to a point that technicians are seeing regular breakouts, that means that the Fed is probably also noting financial conditions easing beyond what they want. And that just means that they're going to tighten further. So I think that what you're going to see is value stocks probably outperform, but I think that you're also going to see a lot of sideways action and failed breakouts and, outperform in relative terms, but maybe just move sideways in absolute terms. On your point about seasonality, I'm actually familiar with what you're talking about in this case, that before election years, stocks tend to perform better. And there's actually a fundamental reason for this that I'm not sure if you've heard before, but it explains a lot of the seasonality. It's that there tends to be more stimulus before election years, which makes sense because incumbents want people to be happy with the economic picture before the elections come up because it improves their odds of re-election. So Invictus, how do we interpret this? Well, we would probably ask that fundamental question first. Are we going to see stimulus into the elections this year? And I think with Congress in gridlock and inflation still running at 5, 6, 7%, depending on how you're measuring it, it's very unlikely that we see further stimulus, and therefore that this would be one time when the seasonality is unlikely to play out like it has historically.
That's very interesting, Stans. I mean, I'd really love to see and maybe come back, next year to this discussion and see how it actually turns. Of course, it's the forecasting is just a matter of probabilities, and we can never be 100% certain, right? So to anybody who's listening, Mike is sharing very valuable points, about being open-minded and of course not assuming something, not extrapolating some odds from the past into the future, which I completely and perfectly agree with. I think there's lots of truth to it, right? So it does sound for overall kind of like perspective that we are not out of the woods, of course, just yet, right? That the situation is still kind of like on the fence of recession, just hiding somewhere around the corner. That's what it seems, and that's what I also understand, from what you mentioned brilliantly. Is that correct?
Yeah, and I'll caveat what I said again by just saying I have a lot of respect for seasonality. It's not something that it's not my forte as an analyst, and so I don't spend a ton of time presenting research on it. But it's right more often than it's not, I suppose, by definition. So I still have a lot of respect for it. It's something that I observe and pay attention to.
Speaking of respect, what hobbies do you respect in life? What hobbies do you invest and dedicate your own time for?
Boy, it's a good question. So, excuse me. So, my son just celebrated his first birthday a couple years.
Congratulations! Happy birthday!
Thank you. Yeah, it was a lot of fun. Multiple celebrations with my wife's side of the family and my family. So that was a lot of fun. He's, having a relatively young baby is a real joy, and of course, also takes a fair amount of time. So he's kind of a hobby a little bit, I guess. I also like working out, weightlifting. My dad was born in Naples, Italy, so I really like opera.
Okay.
Yeah, I've inherited a love of opera, specifically operas by Giacomo Puccini. So I don't know if you hear those in Poland so much.
That's very interesting. I mean, I wasn't aware you had Italian roots and the opera singing. Like, come on, this is pretty cool. You don't see that too often these days, do you?
Well, opera listening, not opera singing for me.
You never know. I just shot my shot. You never know.
Yeah, well, maybe I'll start working on it after I sell Invictus 20 years from now.
Perfect. It does make perfect sense. Of course, you're doing an incredible job for Invictus Research and for all the content that you put out on Twitter, for all the content that you put out in so many other Medium channels. And congratulations again for coming over to Charles Payne. It sounds like you're really reputable in what you're doing, also respected by the people. One point that I would still encourage and press my great beautiful audience to do is to make sure that you guys are following Mike Singleton at CFA on Twitter. This is handle at Invictus Macro, because definitely Mike is a person that deserves the best of the city, the best audience, right? And just looking at this great Twitter account that just provides such a ton of incredible content and incredible value like Mike does, is not following Mike is definitely a big miss out. So I would kind of recommend and send everyone to make sure you go ahead and click the follow button on Mike Singleton CFA. This is probably the best investment recommendation that I can make for this year. And before I let you go, Mike, I know that you're busy, and I'm not going to pull you much longer to stay in here. We have this custom for our The Nest Show podcast show again that our listeners are often given this final golden takeaway and this golden tip that they can just use from our guests. So, Mike, if you were to give this golden takeaway, golden tip for this year for the audience, what would that be?
So it's going to sound like I'm pitching my own book a little bit, but my golden tip for any investor really is don't ignore the business cycle. Like I said at the beginning of the podcast, the business cycle, defined broadly, accounts for between 60 and 80% of the price action for individual stocks, and even more than that for sectors or style factors. And so it's really tempting as an analyst to get into the weeds in a single name and to develop a lot of really strong conviction. And if you do that, I've certainly done that before, you are tempting the market gods to just confuse you to no end. It's really, really important to understand the business cycle when you're analyzing investments. I would go so far as to say there's nothing more important.
What a brilliant way to put it, to put the show to the end in this way. Understanding the business cycle is definitely a great point to the list for everybody who's listening and watching this podcast on the Nest Show. And definitely make sure you follow again Mike Singleton CFA at Invictus Macro, because that's exactly what Mike does and inform about the business cycle and the business sense each and every single day in and day out. Ladies and gentlemen, Mike Singleton CFA has been our guest for today's show. Thank you so much for coming over, Mike.
Yeah, thanks for having me, Adrian.
Thanks. All the best, guys. Till the next one.